right? In the 1980s, right, only like 1%, right, for the whole U.S. portfolios investment, right, in the foreign equities. But with the global market becomes more integrated, right? More and more U.S. capitals are investing in the foreign company stock, right? So especially in the emerging markets, right, the growth rate are faster than a matured economy like the European and the US, right? So for the portfolios, right, you can diversify your holdings, right, by investing in the foreign equities, right? This one will increasing your return, right, in the long term, right? So you can say with the time passed from the 1980 to 2014, right, more and more capitals, right, in the US are investing in the foreign equities, right? Now there are more than 30% of the US portfolios, right, are investing in the foreign equities. And for the foreign equity investments, right, last chapters we will focus on what American depository receipt. Right? Sometimes we want to buy the foreign company stock. Right? How can we do that? For a foreign company, right, if they want to trading in the US, right, they don't need to listing in the US stock exchange directly. Right? For example, you know we have the NYSE and the NASDAQ. And there are these two famous what stock exchange. If a company want to trading in the US, right, they can selling their stock directly in these two exchange. However, to listing the stock directly in the US market, they must to comply with a very strict regulations by under SEC, and the cost will be high, right? You must to hiring, the US lawyers, right? And you must to, prepare your financial statements, right? And everything will be costly and also time consuming, right? To do the trading to listing in the US market, right? So some company are not willing, also can be not ready, right, to do the listing in the US, right? Instead, they will issue ADR, right? So what is ADR? ADR is American Depository Receipt, and this receipt represents the number of the foreign shares that are deposited, right, in the U.S. bank, and the U.S. bank will serve as a intermediary agent, right, to trading ADRs. So let me explain this one in more details. For example, right, if a foreign company, right, for example, right, Toyota want to trading their stock in the US, right? But they don't want to listing in the US market directly. How they will selling their stock into the US without listing in a two stock exchange in the US market? They can do what? They can first deposit their stocks. Right? They have the trading in the Japan, right? So in the Tokyo, right? In the Tokyo stock exchange, right? They have the stock already in the trading, right? So they will first selling their stock in the Japanese market, right, to US bank. For example, right, BOA and also Chase, right? So they selling the stock to these two banks, right? To be more accurate, not selling, right, but deposit. So they will open an account, right, in these banks, right? Once the account are approved and open, right, they will deposit their stocks right into this account. And once the US bank receive this stock, they will combine these stocks shares, right, or convert these stock shares, right, to the ADR. Right? For example, Toyota deposit 1 million shares, right, to the US bank. And once the US bank received these 1 million shares, they will convert these shares to ADR. For example, 10 shares into one ADR, right? So after this conversion, right? So 1 million shares will become what? Become 100,000 ADRs, right? And these ADRs will be trading in what? In our stock change, either in a NYSE or in a Nasdaq, right? There are more ADRs available in the Nasdaq. Right? So for example, if you want to buy the Toyota ADRs, right, you will buy, for example, one ADR. What that means? Means the investor actually, holding what? 10 share of Toyota Toyota stocks, right? So if you want to convert this ADR to the stock shares, you will give a call to the bank, right? The bank will use your receipt of the ADR, right, to convert this ADR to original shares, right? So you can say that's the conversion, right, made by what? By the banks, right? So banks are intermediary, also called a transfer agent, right? Transfer agent. So let's say the advantage of ADRs. So while the company prefer, right, to do the ADR, not cross listing, right, not do the cross listing. Right? Some big companies, right, they will do a cross listing in the US directly in the stock exchange. Right? For example, you see the biggest cross listing, right, is the Alibaba, right, on the 2017, right, it's the cross listing of Alibaba stock, right? So it's from the foreign companies, right, but it's listing in what? In the New York Stock Exchange. Right? So why more companies prefer to do ADR, not do the cross listing directly in the US? I say what's the advantage of ADRs? First, you can say ADR are denominated in what? In the US dollars, right? And also trading in what? Trading in the US exchange, right? So can be bought directly through any brokers, right? So even ADR contains the foreign stock shares, right? But they already trading in the US with what? US dollars, right? So it's very easy to do what? To do the trading. Second, right? Dividends will be automatically paid in what? In US dollars, right? So for example, if the Toyota, right, pay dividends in the Japan, right, use the Japanese yen. Once they announce these dividends payment, right, then the BOA will also receive dividends in their account, and they will use the spot exchange rate, right, to convert this dividend to US dollar and pay to the US investor, right, at the same time. So there's no disparity between what? Between the US investor and Japanese investors, right? Because our bank are the guarantee of these payments are made, right, on time. Third, right, most underlying stocks are what? Are bearer securities, right? You know the bearer securities, right? We studied this one in the last class, right? Bearer means what? Bearer means the securities are what? Are trading anonymous, right? Anonymous, right? So you don't know who holding the stock, right, on the chart, right? No one know who hold this stock right now, right? Because we trading the stock anonymous, right? However, because the ADR is issued with what? With original shares in a foreign company, right? So SEC request ADR are registered, right? So for every investors holding the ADRs, right, their name will be registered in a bank and also registered in a company issued ADR. So SEC will guarantee that ADR will be never, default. Right? That's some advantage for ADR over some foreign stock you purchase directly from the foreign market. Fourth, right? ADR also trading with what? With a short time period, right? So you can say once you finish the trade, right, your amount will be clear in the 3 business days. Right? However, if you bought the foreign stock directly in the foreign markets, if you want to settle with your payment, right, the payment will be not made to your account easily, right? Because there's there's a possible worry about what exchange rate over next few days, and also there's legal regulations, right? If you want to transfer money back from the foreign countries, if the regulations block by foreign investors to receive the money, you will take a risk. Right? However, for ADR, you don't take this underlying risk. Right? You will receive the payment directly, right, in a 3 business days, because this one's guaranteed by what? By the bank. Right? So that's the advantage of ADR compared with the traditional stock you can purchase from what? From a foreign bank, a foreign market. Sorry. Right, so that's ADR. Right, so let's see the detail. For example, let's Volvo ADR. Right, you know the Volvo is a company in what? In Sweden. Right, Sweden is famous now for what? For the herd immunity. Right, not like the US. Right, we have the social distance. Right, we want to stay at home. Right, to avoid spreading of what? To avoid spreading of the COVID-19, the virus, right? However, for Sweden, right, they don't testing the virus, right? So they use what? They use the herd immunity, right? So they just like people, get infected, right? Not naturally, right? Because they believe if you get older, right, and get unhealthy, then you cannot avoid to risk your life, right, to the death. And so, they believe the death is a natural, outcome, right? So their, fertility rate, right, is very high, right? But people, still stay in a normal life, right? So people, kids are still go to school, right? And the workers still go to the factory, right? The company is still working. Nothing has been changed, right? So they use what? Herd immunity. However, there are much more, much higher, right? People, fertility rate, right? And if you look at Sweden, right, it's the only country right now, use the herd immunity, right, to against this virus, right? And the Volvo is a famous car brand, right? You know the Volvo is very stable, right? If you drive the Volvo and then you drink the water, right, and you can feel, right, the Volvo is very stable, right? Even you go to the up hills and down hills, right, you cannot feel like the shaking of like the regular Japanese car, right? I used to drive the Volvo, test driving right before, and if you drive the Volvo, you can feel the difference, right? So you can see here, right? If a Volvo company decides to selling the stock to the US market, right? And then they decide to use what? To use ADR, right? Let's see what happened. And Volvo tried to trade in the US on the Nasdaq, right? Using the ticker VOLV, right? VOLV is the ticker for their what? For their ADR, right? They already has the stock trading in the Swedish market, right, under the ticker VOLB, right? So how they will convert this stock into the ADR in the US? First, they will deposit their original stock issued in the Swedish market, right, into the JP Morgan. Then JP Morgan, these divisions responsible for ADR conversion, they will receive the original shares deposited by the Volvo, then convert to ADR. Right? Once the conversion is completed, right, then ADR will be what? Will be selling directly in what? In the Nasdaq market. right? And you see here, right? For this transaction, right, they must to have a custodian, right? What this one means? Means, the shares firstly will transfer, right, from the Volvo to the, Swedish firm, right? SE Banken custody, right? Then these shares will be electronically transferred to the JP Morgan, right? So in between the Volvo, right, and US investors, right, there are two intermediary in between, right? One is the bank, one is the financial firm, or the bank in the Swedish, right? Is what? In the Sweden, right? That's what? That's the SE Banken custody, right? After they receive the Volvo stock, right, then they will electronically transfer to the JP Morgan, right? JP Morgan will then combine, right, the shares of the Volvo B, right, to the Volvo Y ADR, right, then selling to US investors on Nasdaq. Right, you can see there are two intermediaries, right, in between Volvo and the US investors, right? So these intermediary systems, right, can reduce the risk for US investors, right, to guarantee, right, your payment will be settled, right, on time. And you see there are many, research on the cross listing and ADRs, right? So what's the finding in this empirical research? And you can see here, right? For our diversified portfolios, if they contain ADRs, right, they are usually outperform by both US stock market and also world stock market benchmark on risk-adjusted basis. So with our portfolios, right, including ADRs, right, the performance will be better than the pure stock, right, in the portfolios, right? So for your investment in the future, you can also think about what ADR, right? If you found some foreign companies are very attractive, right, you can also consider to put your ADR, right, into your investment, right? So for most stocks, the home market price and ADR price is a small what? Very small difference, right? This difference is only what? Only 20 basis points, right? The basis points means 0.0020, right? And 85 is 0.0085. So only a minor difference. So you can say because the difference are very, very tiny, right? And that's what? There's a very few what? Arbitrage opportunities, right? If the price are very different, like across the countries, you can always what? You can always buy low and sell high simultaneously, right, to make our arbitrage profit. However, because the difference are very tiny, right, across the countries, so there's no arbitrage opportunities, right, means the ADR, right, will be also fair priced, right, in the US market, right? So you can either purchase the original shares in the foreign market, or you get ADR in the US market. They are what? They are fair priced. And also in the US, if you purchase ADR, right, that's what? That's regulations, right, to monitor ADRs. And so you can also reduce your risk. So first, ADR is fair price with the foreign original shares, right? Second, ADR is under SEC regulations. So these two mechanisms, right, actually, shows the strength of ADR tradings, right? You can either you can both exposure to the what? Foreign investment, right, in the foreign companies. Also, you can enjoy the risk control, right, from the compliance to the SEC. So that's why ADRs are good what? Investment choice. So let's say some, questions. ADR, right, are frequently represent a multiple of underlying shares. So this one is what is correct, right? ADR is for the, for our receipt, right? convert from what? From multiple shares, right, in a foreign companies, right? So this one is correct. Second, ADR can trade on the NYSE and also can trade on a NASDAQ. So both B and C are also correct. So A, B, C, these three choices are all correct, right? So we will choose what? All the options, right? We will choose all options. So let's go to the next one. So this one we have some calculations, right? In a Frankfurt, right, market, Aldi, right? You know Aldi's grocery store, right? Like the like the Trader Joe, right? Trader Joe is very popular, right? Especially in Manhattan, right? And also the Aldi is very popular, right? It's from the German, right? So in many cities, right? In many states, right? Maybe you cannot find a Trader Joe, but you can find Aldi nearby, right? For example, I used to live in in Ohio and West Virginia, right? So we don't see any Trader Joe around, but we see what many Aldi, right, has the store, right? So we go to Aldi, you can buy many food, and especially you can buy some food imported from the Germany, right? For example, the sausage, right, and also the ham, right, imported from the German, right, is very good, right? And also the price of the Aldi, right, usually are cheaper than the Trader Joe, right? So if you never purchase the food from the Aldi, you can try, right? Especially these days, right? Usually I purchase the grocery from the Trader Joe and from the Costco, right? But recent days, right, I order grocery directly from Aldi, right, because the price are cheaper, right, than a Trader Joe, and also the quantities, right, it's not that big compared with the Costco, right? You buy from the Costco, right, you will receive a large quantity of the food, right? You cannot consume, right, and in time, right? So sometimes, right, the food will get rotten, right? So usually we buy the small quantities from Aldi, right? It's very convenient, right? So in the Frankfurt market, Aldi stock, right, closed at €5 per share. So you can see Aldi stock are originally traded in the what? In the German, right? With €5 per share. On the same day, right, the euro US dollar spot exchange rate was 6.25 euro per dollars, right? Aldi also trade as ADR in the OTC market, right? What's the OTC? Over-the-counter market in the US. 5 underlying Aldi shares are packaged into one ADR. What that means? Means one ADR, right, represent what? 5 shares of Aldi stock. There's no arbitrage US price of ADR. So this sentence, further confirm, right? The 5 shares price was exactly same as one ADR, right? There's no price disparity between the US and German, right? So let's say what's the price, right? What's the price should be what in the US ADR? So one ADR, right, equal to what? 5 shares, right? Based on this one, based on this sentence, right? Highlight in what in a yellow, right? So what's the stock price in a German? €5 per share, right? So 5 times 5 equal to what? Equal to the €25, right? And you can also solve the dollars by use what? Use the exchange rate, right? And you can say we have the 6.25 euro per dollar, right? So use this one, you can solve the how much dollars, right, for the 5 shares, right, in the German, right? So 25 divided by what? 5/8, right? So 25 times 5 and 5 will be cancelled out, right? 5 times 8 will be what? $40, right? So we can say that's the $40 value of the stock in the German will be exactly same as the value in what? In the US, right? So that will be $40 one ADR, right? So you can say here, right? First, we will combine 5 ADRs, right, into one. We will first combine, right, 5 shares of stock into one ADR, right? Then use our exchange rate to convert, right, the euro to dollars. Right, so that's our step, right? First, we will combine 5 shares into one ADR. Second, we will transfer the euro to dollars, right, to see the price in the US, right? So that's our calculations for this question. Next one, right? Next one, similar, right? But here's for what? For a Rolls-Royce stock, right? Rolls-Royce stock is a famous brand for what? For the car, right? For the car, luxury car, right? And this stock are trading what in the UK, in London, right? The price is 0.875 pound per share. On the same day, the British pound sterling, right, to the US dollar spot exchange rate was what? Was 0.6366 pound per dollar. The Rolls-Royce, right, Rolls-Royce trade as an ADR in the OTC market in the US, right? 5 underlying Rolls-Royce shares were packaged into one ADR, right? So you can see this conversion actually same as the Audi stock in the last questions. Also will be 5 shares, right? 5 shares into one ADR, right? 5 shares will be combined into one ADR. If the Rolls-Royce ADRs were trading at $5.75, while underlying shares were trading in London for 0.875 pound per share, right? Is any arbitrage profit you can get, right? So we want to check, is these two with the same value or not, right? If these two are not with the same value on the same currency, right? That will be what? That will be an arbitrage opportunities. And so let's take the calculations, right? What's the value for the 5 shares? So 5 shares in the UK, right, will be in a pound, right? So 5 times 0.875, right? And this one is in a pound. We want to transfer the pound into the dollars, right? To make a comparison with the value in the US, right? So we will transfer this one to a dollar. Use what? You can see here, right? $1 equal to what? 0.6366 pound, right? So we will divide by what? We will divide by 0.6366, right? To solve how much dollars for these 5 shares in what? In the UK, right? In the US, we know the value for the ADR directly from the market forward for 8.75, right? 8.75 in the US, right? So let's compare, right? These two numbers are same or different. So first, let's do the calculation for this one, right? If you do a calculation for this one, you can solve, right? The value will be what? Will be $6.87, right? But in the US is what? In the US is $5.75 per ADR, right? So both represent what? 5 shares, right? But in the US are what? Are cheaper, right? Cheaper in the US, more expensive in the UK. So what you will do? You will first borrow the money, right, to purchase the ADR, right, in the US, right? So you will borrow money to buy ADR in what? In US. At the same time, right? At the same time, you will sell 5 shares, right? You will borrow money, right? This borrow dollar, right, to buy ADR, right? In the US, that's for the US, right? But for the UK, you will do something different, right? You will borrow what? You will borrow the shares, right? You borrow 5 shares, right, to sell to what? To sell to UK investors, right? So if you borrow money to buy ADR, right, in the US, right, how ADR you purchase? You just purchase what? One ADR, right? At the same time, you was selling what? You were selling 5 shares in the UK. And if you borrow money to borrow the shares to sell, you must to pay these 5 shares back, right? How you will pay these 5 shares back? Then you will use the ADI you bought in the US, right, to what? To convert to the 5 shares, right? Then you cover what you borrowed what in the UK, right? And then you sell these shares directly to the UK, right? To use the money to pay the money you borrowed in the US, right? So you can see there's nothing you use yourself money, right? Everything you just use what you borrowed, right? But you can make a profit. Why? Because you can see here, right? What you pay in the US, 5.75, right? What you get in the UK, 6.87, right? What's the profit? Will be the difference, right? Will be $1.12, right? So that's the arbitrage profit. Be careful for arbitrage profit. You never use your own money, right? You will use something you borrowed, right, to sell high and buy low at the same time, right, to realize the profit, right? That's our definition of the arbitrage profit. Right? So this is for the chapter on the global equity market. I hope today's class can show you how to do a calculation for ADR. Right? So if you have any questions about ADR problems, right, please let me know. For the final, right, we will also see some questions forward for the ADR. Right? So please, review these questions if you can. And before we go to the portfolio chapters, right, let me show you something, right? We just get from the Amazons, right? And this is the data just released, right, from the Amazons, right? Let me show you the detail, right? So Amazon collecting the data for the e-commerce, right? For the recent months, right? And compare, the same demand, right, in the last year, right? Say which goods, right, are most popular in the e-commerce recently, and which one got least popular, right, in the recent months. You can see here, right? If you cannot see this one clear, let me read this one for you, right? So which one sells the best, right, during the pandemic of the coronavirus, right, is what? Is the gloves, right? Gloves increased by 670%, right, in March and April, right? Second one is the bread machine, right? And this is third popular online, right? Not just for Amazon, for all the e-commerce website, right? The first one is the disposable gloves, right? Second is the bread machine, right? Third is the medicine for the cough and cold, right? Fourth is the soups, right? And five is the dried grains and rice. Six is the packaged food, right? Seven is the fruit cups, right? Eight is what? Weight training, right? Seems like many people do the physical access at home, right? So weight training device are also third popular on what online, right? Nine is the milk cream, right? You can see the many category here, right? So this is the top 10, right? Popular goods, right, selling on the e-commerce, right, in the recent months, right? But which one lost the appearing, right, in the recent months is here, right? Which one reduce a lot, right, in the demand is first one is what is the luggage and what suitcase, right? Because people are not travel anymore, right? People stay at home, right? So for any briefcase and the suitcase, right, now it's not too many people to demand to buy this stuff online. right? Third one is the cameras, right? Fourth one is men's swimwear, right? You see, for the most state, right, the beach still closed, right? Even Florida and some, place reopen their beach, right? But most states, right, still close the, public park for the beach area, right? So that's why, not many people demand for the swimwear, right? The fifth one is the bridal clothing. Sixth one is the men's formal wear, right? And then you stay at home, right? Even for the interviews, right? It will be what? It will be through the what? Through the maybe the online through the Zoom, right? So not many people buy what? Buy the formal clothes and the swimwear, right? And also you can see the other sectors, right? So why I show this chart to you? Because this one actually shows the demand and supply for the e-commerce goods, right? In the recent months. So if you do the investment, either for a stock, right, or for the real companies, you can think about it, right? So don't choose the, the category with the fastest, declining, right? If you choose the investment in this category, right, you are possible to lose the, money, right, in the future, right? Because these sectors are shrinking very soon, right? And you are not expecting this one will recover easily, right? For example, car anti-theft, right? If the people park the car not driving, right? So there's also no demand for what anti-theft for the car, right? And also you can think about about why, you know name macros, right? Or maybe the other like J. Crew, right? J. Crew today, right? Announced they were filing forward bankruptcy, right? So many sectors in this area, right, were not easy, right, in the following months, right? Maybe they were what? They will, file a bankruptcy, right? So if you want to short the sectors, right, this part can be do a short, right? And for the part above it, right, this one can be what? Can be a good investment, right? Can be a longing, right? Long positions, right? For example, right? Like the gloves company, right? And also, weight training device, right? So you can see the maybe the first quarter and the second quarters, right? Their revenue will goes up, right? For these companies, right? So that's my showing of this chart for today's class, right? And I'm not sure you have, seen this graph before or not, right? If you never seen this graph, right? So I think you can get some idea, right, from this graph. And the final paper, right? Final paper is due. Let me see the date, right? Final paper will be due on the not 11, will be due on the 18, the same day we take the exam, right? So our final paper, the final paper will be due on 18th, right? The same day we take the exam, right? So it's not 11 but 18, right? So you have the 2 week, right, to do the papers, right? And if you have no idea, right, how to organize this paper, you can read my sample paper on Blackboard. And also for option 2, right, there are many discussions online, right, for the big short and for default, right? You can get some idea, right, from the from the discussion online, and also from some forums, right, and from some people's social media, right? They also have some feedback, right, for these 2 movies, right? You can get some idea, right, from that. And also there's a detailed video on YouTube, right, explain the credit default swap, right, in the big short, right? So you can watch that movie, right? Or sorry, watch that video, right, for the idea for the credit default swap, right, in a big short. Okay, so for today's class, we will study what? We will study the global portfolio market. Right? In this chapter, there are many, calculations we need to capture, right? So let's see the details, right? The first one, Suppose you are euro-based investors, right? You just bought what? You just bought and selling what? Microsoft shares, right? MSFT, Microsoft shares, right? And you bought 6 months ago. Because you are euro investors, right, from the European area, right? So you use what? You use the euro to do what? To do investment, right? So that's the special part for our course only, right? If you have taken investment course or the other finance course, right, everything may be more straightforward. But for our course, the only thing different and very special feature for this course is for the foreign exchange, right? Foreign exchange, right? You are supposed doing the investment globally, right? So every investment, not just the capital gain, right? You will pay attention, and also you will pay attention to what? To the change of what? Foreign exchange rate, right? So for example, right here, right, for these investors, he spent what? He spent euro to do investment. He bought Microsoft shares for what? $120 per share. And when he purchased the stock, right, the exchange rate was $1.15 per euro. After 6 months, right, the stock are sold forward for $135 per share. And also, after he received the money, he convert the dollar back to euros, right? Use the exchange rate on the market forward $1.06 per euro. So first, you need to determine, right, what's the profit from this investment in the euro terms. Second, please compute what's the rate of return on your investment in the euro terms, right? And how much proportion of return is due to the change of what? Exchange rate, right? If there's only one currency, right, in the questions, then you will just check the price change for this stock. However, because there are two currency, right, both dollars and euro in this transaction, so we also need to check what's the change of exchange rate cause the gain for this investment, right? What's your return? You want to check what? You want to check how much money you get, right, from this investment, right? First, let's say what's the money in the US dollars you do the investment, right? You see original money you hold is euros, right? But you purchase stock, right, in the US, right? So you want to convert this euro to a dollar and first, right? So we have the 10,000 euros, right? But we want to first convert this one to a dollar to purchase Microsoft stock, right? So 10,000 euro times $1.15 per euro, right? We solve how much dollars, right, in the US market. Then this one will go to purchase what? Microsoft stock, right, for $120 per share, right? So we will divide by $120 per share. We will say how many shares you can buy, right, for the Microsoft, right? And this one will times what? Times $135 per share, right? Because when you sell the stock after 6 months, you sell the stock forward for $135 per share, not $120 per share anymore, right? And this is in the dollars. But as investors, right, you from European, of course, you need to convert dollars back to euros, right? How much euros you can get after 6 months is based on the exchange rate, right? After 6 months, you can see exchange rate now, right, will be $1.06 per euro. So you will divide by what? You will divide by $1.06 per euro to transfer this money to what? To euros, right? And this is the how much money you can get after you selling the stock, right? Minus what you paid for the stock initially in the euros, right? The difference will be the profit you get, right, from this investment. That's the total profit, right, from this investment. One is the ending value, right, in the euro after you selling the stock, right? One is the beginning values. You purchase the stock. The difference will be the profit you made, right, from this investment. Next, we will check how much return you get in this investment. Use the percentage numbers, right? And also we will explain how much of this return comes from the exchange rate movement. And for this one, we will use a formula, right? Return will including what? Two parts. The first one is the price change. It's the price change over the what? Over the 6 months. The next part will be what? Will be the source of the change of what? Exchange rate. And this is a change of the stock price. For a change of stock price, right, we call this one as what? As capital gain or capital loss. Right? If the price going down, will be a loss. If the price goes up, will be capital gain. Right? So this one is the capital gain or loss. Right? But this part is from our change of foreign exchange rate. Let's see the detail. Right? For the price change, you see when you purchase the stock, it costs what? It costs $120 per share. When you sell the stock, you sell the stock for what? $135 per share. So the price difference is 135 minus 120, right? Over beginning price, right? So that's the percentage change of the price. This one we call what? Capital gain in percentage. So that's the only one source of your income comes from. You can also enjoy, right, the price appreciation because of what? Because of the dollar appreciate. Right? How you make the money from a dollar appreciation from its investment? We use this part. At beginning, right, for $1, it's equal to how much euros, right? You will based on the exchange rate, right? And the beginning of the investment is $1.15 per euro, $1.15 per euro, right? So for $1, how much euro it valuate will be $1 or what? $1.15 per euro, right? After you selling the stock, right? How much euro it will be valued? You can see here, right? After you sell the stock, right? You see the exchange rate is $1.06 per euro, $1.06 per euro, right? So you can see after you sell the stock, right? What's the value for $1 now in the euro will be 1 over what? 1.06, right? So you can say your $1 are increased value over time, right? Over the 6 months investment period, right? So this is the gain from the change of the exchange rate, right? Over the beginning value of $1 in the euro. So this part is from what? Is from the exchange rate appreciation. This part is from the capital gain from the stock price. So these two parts forms our what? Total return. Be careful, right? So our total return, including the two parts, one is the capital gain of the stock price, the other part from the change of what? Exchange rate. You can see here, right? So our total profit is 2,100 euros, right? And from this 21% return, 12.5% is comes from what? Comes from the stock price change. The other 8.5% is from the appreciation of the dollar, right, in the US market. Right? As our European investors, you are lucky, right? You put your money not in the European, but you put the money in the US market. Right? So when the dollar appreciate, after you transfer the dollar to euro, you also enjoy what? The dollar's appreciation. So this part is from the dollar's appreciation. Right? So that's what this question tells you about. Right? So for our global investors, right, and also that's a special part of this course. When we solve the return, Not just the pure capital gains, you will pay attention also from what? From the change of the exchange rate over the 6 months, right? So that's the special part of this course about. So that's why you study this course, right, in this method. We will check what? The change of exchange rate. So next questions. Miss James, right? International investors, right? So you can see the questions, right? Every time we will emphasize, right? It is global investors, right? So we will say something about what? About currency, about exchange rate. James just sold his stock by Nestle, right? The Swiss firm, and this stock, right, is selling for the Swiss franc what? 5,080 Swiss franc. The share was bought for the Swiss franc $4,600, 4,600 Swiss franc 1 year ago. The exchange rate now is what? 1.6 Swiss franc per US dollars, but was 1.78 Swiss franc per dollars 1 year ago. Ms. Sieber also received Swiss franc 120 as a cash dividend when she's selling the stock. So can you compute rate of return for this investment in terms of what? US dollars, right? So this one is very important. We want to capture return, right, in the US dollars, not in the Swiss franc. So everything in the questions about Swiss franc must to convert what? To the US dollars and first. Right? So I say what's the value for the Swiss franc in the dollars? When he purchased this stock, right? How much he purchased? 4,600, right? Swiss franc and beginnings, right? And this one's equal to how much US dollars? We will use our exchange rate 1 year ago, right? 1.78 Swiss franc per dollars, right? So this one will divide by 1.78 Swiss franc per dollars, right? So you can say that's how much dollars when he purchased this stock. What's the value of this stock after he sold this one? When he sold this stock, he sold for what? 5080, right? 5080 Swiss franc. That's how much he sold this stock for, right? And also at the same time, he received dividend 120 Swiss franc. So this is the price he sold for the stock, and this is the dividend he received. Both will be the balance when he sold his stock, right, in his account. And this is in a Swiss franc. We want to convert this one to dollars. What's the exchange rate right now? It's 1.6 Swiss franc per dollar. So we will divide by 1.6 Swiss franc per dollar. So you can say this is the value when he sold the stock, right? After 1 year. And this is the value at beginning. So let's now check the return. Return will be the ending value minus the beginning value, then over beginning value times 100%, right? So we have the 5080 plus 120, right, over 1.6 minus 4600 over 1.78. The difference, right, over beginning, right, 4600 over 1.78, right, times 100 what percent, right? So this is the ending value, right, including the price he sold for the stock, and also cash dividend he received. And this is the beginning values, right, in the US dollars. And this beginning value times what? 100%, right? That's the return, and that's the return should be calculated. So return equal to what? Return equal to 76%, right, in the US dollar terms, right, in the US dollar terms. Next one, right, this one, we actually saw this one before, right, in our homework, right, so that's the second time we study these questions, right, so please take some notes, right, we are sure, right, there's similar questions in the final, right, about these problems. Japan Life Insurance Company, right, invited $10 million, right, in a pure discount US bond in May 1995. One exchange rate was 80 yen per dollar. The company then liquidated this investment after 1 year. For what? For $10,650,000. The exchange rate turned out to be what? 110 yen per dollar at the time of what? Liquidations. And then let's say the questions. The question asks you to solve what? Rate of return, right? On this investment in what terms? In the yen terms, right? Not in the dollar term. You can say our numbers in the questions are in the dollar term, but here we're asking for what? Yen term. So everything must to transfer to the yen, right? When you do the calculations, right? What's this one in the yen? Based on the original exchange rate, 80 yen per dollars, right? So we have the $10 million times 80 yen per dollar. We solve the value when a life insurance company purchased this fund, right? Purchased this bond on the 1995. And that's the beginning values, right? This is the beginning value, right? It's beginning value. What's the ending value? When the company liquidated this investment 1 year later, right? They sell for what? They sell for the $10,650,000, right? But this should be in the yen term, right? So what's the yen? Yen now will be 110 yen, right, per dollar. So this is the ending value, right? What's the return? Return will be the end minus beginning over beginning, right, times 100%, right? So it's very easy, right? Just plug this number into the place, into the formula directly, right? So we have what? We have the 10,000, right? 10,000 is the beginning values, right? $10,000 times 80, right, will be 800 million yen. That's beginning, right? What's the ending? Ending is the 10,650 times 110, right? So you can do the calculations, right? To also record as what? Yen in the million, right? The difference divided by the 800 million will be the total return, right? So let's see the calculation in the next slide, right? So you can see we have the 1.171, right? 1171.5 million yen, right? Minus 800 million yen over 800, right, million yen, right? We solve what? We solve the 46.44%. That's our total return, right? And this total return including what? Including the two parts. The first part is the coming from the price change for this bond, and the price change is what? It's from the 10 million, right, to what? To 10,650, right, $1,000, and so we can see the price change, right, is the 10,650,000 minus 10 million over what? 10 million, right? So that's the capital gain, right? Capital gain comes from, right? Second part is what? Is the exchange rate appreciation, right? But for these calculations, we must to transfer everything into the yen. Be careful, right? So this one you should also transfer to the yen, right? When you solve return. But for the appreciation of the yen, right? It's already in already in a yen per dollars, right? So we will do this one directly, right? So it will be 110 minus 80 over 80, right? So you can see that's the exchange rate, right? Appreciation, right? So we have we have a two part of the return comes from. This part is from the price change, and this part is from foreign exchange rate appreciation, right? Because the life insurance companies from Japan, they invest in the money in the US dollars, right? So when the dollars appreciate from the 80 yen per dollar to 110 yen per dollar, they also enjoy this part of return, right? So if I give you a questions in the final, ask you to solve total return and also return from exchange rate, you need to show these two numbers, right? In a multiple choice, right, for these questions, right? So that's for our questions, right? For the return measurement, right? For return measurement is a very important key, right? To compare global portfolios, right? Global portfolio investment. You see here, right? So when you compare two global portfolio investment, we always to try to locate these portfolios on a variance mean analysis, right? So this is represent risk, right? Sigma represent risk, right? It's called standard deviations, right? And this one is expected return, right? This is return. So we will usually place our investment on this chart, right, to see which one is better. Right? For example, if this one is A, right, this one is the B, and this one is the C, right? Which one is the best? You see, A is A is better than Than B, because with the same risk, right? A has with the same risk, right? A has a higher return, right? And also B is B is better than the C, because for the same return, right? For the same return, right? Which one has less risk? B has less risk, right? So A is bigger than B. B is better than C. So A dominate both B and C, right? In this investment, chart. So we call this chart as a mean variance, right? Analysis. And this is very famous modern portfolio theory, right? A guy, the name called Markowitz, right? He, found this mean variance analysis, and he win the Nobel Prize because this modern portfolio theory, study, right? So in this global portfolio chapters, we also will, focus on the return and risk, right, for the global investment portfolios, right? So we just study the return, right, in these three questions, right? We see our return, including both capital gain and capital loss, and also, foreign exchange rate, appreciation and depreciation, right? So that's the special part for our course, right? It's the foreign exchange rate change, right? This is the capital gain or loss, right? This is for our exchange rate will be appreciate or depreciate, right? And also our risk will be also another concern, right? When we study our portfolios, right, do the comparison. So I say some questions, right, for these chapters, right, on our textbook, right? Suppose we get this, chart, like get this table, right? So there are two stock market, right? One is the US market, one is the UK market. For US market, right, we have the 1.26% per month as return. The risk is 4.43%. For UK, it is 1.23% return. Risk is 5.5% risk. And we also are given, you see here, correlation coefficient between these two markets, 0.58. And you can see here, suppose you invest equally, right? This is very important, right? If you see the investing equally, what that means? Means you split your money into this investment equally, right? So 50% will be in the US market, 50% will be in the UK market. That's why we call what? Invest equally. So let's determine what's the expiry return and what's the risk for these international portfolios. So we spend 50% in the US market and 50% in the UK market, right? Today, right? The Warren Buffett, right? In his, announcement, he said, right? He don't buy any specific stock, right? For this time, but he will, betting on the US whole market, right? So if you want to buy the whole market, right? You can buy what? You can buy the whole S&P 500 what index, right? And Buffett already selling all the airline companies stock, right, including United Airline, right, American Airline, and the other airline ticket company stocks, right? He only holding some basic sector stocks, right? And he not try to buy any specific company right now, but he bidding on what on the whole index, right, on the whole market, right? That's our S&P 500, right? So you can see here, right? This investor do the same thing, right? He buy the whole market, right? 50% in the US market, 50% in what UK market, right? So the first one, what's the expiry return based on these portfolios, right? You can see here, 50% in the US market, right? And 50% in what? UK market, and so 50% times what? 1.23%, right? So you can see that's the portfolio's return, right? We call this one as what? As the weight, right? And this one we call it what? Expiry return, right? For the US and then for UK. So our formula, right, for our portfolio's return will be what? RP equal to what? W1 times R1, right, plus W2 times R2, right? So for here, we have the WUS times RUS, WUK times RUK, right? And you see the W means what? Means the weight, right? And R here means what? Return, right? So that's our portfolio's return, and should be solved, right? So that's equal to 1.245%, right? That's our portfolio's return, right? Now we can also solve the risk for this portfolio, right? Like we mentioned, right, in our chart here, right? You are not just concerned about return. Risk should be also, a big concern, right, when you choose portfolio. How to measure the portfolio's risk? We also have a formula you should study before, right? The portfolio risk, right? We call sigma p, right? Sigma p square, the variance equal to what? W1 square sigma 1 square plus W2 square sigma 2 square 2 times W1 W2, right? Correlation coefficient, right? Times what? Sigma 1 sigma 2, right? So let's specify each symbol, right, in this equation. W we already mentioned is the weight. What's the sigma? Sigma is the risk. So here, this one is the sigma, right? So this is the risk for the US is this one, right? And this is the risk for the UK should be here, right? And the last term in this equation is 2 times what? 2 times W1, W2, right? Then times what? Correlation coefficient, right? Rho is here. Then times sigma 1, right? Sigma 2. After you solve these summations, you take a square root. You see this square of what? Risk. It's not just for a single risk, right? So after you solve these summations, you take a square root. You solve the portfolio's risk eventually, right? So that's our formulas, right? This formula you should study in a class for what? For principle of finance or investment course, right? So we will not go to detail. You can write this formula down, right, for this measurement. And why we have the correlations, right? Because the correlation can help us, right, to reduce risk, right? Let me show you some, intuitions, right, for these correlations, right? Because for our global portfolios, we will also see these, correlations, right, to help us to reduce risk, right, for multiple countries, right, investment, right? For example, if the A country stock perform like this way, right? And for B country stock, right? B country stock performing like this way. What that means, you can see here, right? Every time when A moving up, right? B is moving down, right? When A moving down, B is what? Moving up, right? So A and B stock are moving totally what? In the opposite directions. In such case, right, we call these two company stock or two country stock has a what? Has a negative what? Negative correlation coefficient, right? So when you put these two stocks into one portfolios, right, you see, right, if you add these two dots up, right, with the same time, you adding the dot together, right, you can see the curve, right, this is the return, right, this return, right, you see return will be what? Will be formed with a much lower what? Variations, right? We have such high variations before, but once you put these two together, you can see this one and this one will be what? Will be cancel off, right? So will be become a small numbers, right? Just what? Just around these lines, right? So you can see our return will be what? Will be stabilized, right? You not sacrifice the return itself, but you actually reduce what? You reduce the fluctuation. You reduce what? Variation, right? So that's our, benefits to what? To do diversifications, right? Diversification. So you may wonder why Warren Buffett not just buy one company stock, why he choose different stock, different sectors into the portfolio? Because stock can move in opposite directions, right? Some rainy days, right? A stock performing well, but some sunny days, right? B performing well, right? So they can hedge each other, right? Through diversifications, right? Your risk are reduced, right? But return can still maintain in our maintain an optimal level. So that's why we need to study what? Diversification, right? Especially for the global portfolios, right? We can use our multinationals, right? Strengths, right, in different markets to reduce the risk even further, right? Even further. So we can reduce the risk even further. Use the foreign market what? Stock into the portfolios, right? You can see even from the previous empirical research from ADR, right? You see the traditional portfolios without ADR with more risk compared with the portfolios with ADR, right, into the compensations. You can see here, right? But in the future, you can see our security return becomes less correlated, right? across the countries than within a country. Right? You see, if a whole market tumbled in the US, right? Even you are in a big companies, right? In a good company like the Amazon, right? If the whole market go to the downside, right? Amazon stock will also go to the downside. That's no exception, right? However, if you also allocate your money in a foreign country, right? Maybe your stock was still what going up, right? So you reduce your risk even further, right? If you put money into the foreign countries equity market, right? This is why this one is true, because economic, political, and institution, and even psychological factors will be different from the countries, right? So it will result in low correlations among the international securities, right? For example, in our final paper, option one, right? While you try to expanding your business into the foreign markets, please also consider the difference in what? In economic, political, institution, right? Culture, and also psychological factors, right? For example, while you try to what? Expand your restaurants, right, into a foreign country, make sure that you also comply with what? Some culture difference, right, in a foreign country. You know, in some country, especially for Islamic, right, country, they don't eat what? They don't eat the red meat, right? So you need to pay attention to that, right? Some, you know, some people, because the religion, right? And in the India, they also don't eat what? Red meat, right? They only, eat white meat, right? So when you open restaurant, you want to pay attention to this difference, right? And also the other difference, right? You can mention that, right, when you try to design expansion plans, right, for your business, right, into the foreign countries. You can see here, right? This is the curve for the US, right? From what? From the Morgan Stanley, right? Morgan Stanley try to forecast, right? What's the pandemic will be controlled, right? In the following months, right? Especially for the whole year, right? So Morgan Stanley is forecast, right? They do the forecasting on March 20, right? They forecast the US case will reach the peak, right? The growth of the new case, right, will reach the peak, right, around what? Around the middle of the April, right? Then the increase of the new case will going down gradually, right, until July, right? That will be, the new case will be touch zero, right, or maybe close to zero, right? Then with the possible, control of the virus, right? You can see the number will be touch zero, right? For what? For the July, August, September, October, and November, right? But once the weather getting colder, right? They predict there will be potential second wave of what? Infections, right? So how to control this virus eventually, right? Not just for the US or maybe even in a global perspective, right? We need to have our vaccine, right? Like our flu, right? We have a flu shot, right? We must have a COVID shot, right? To control the virus eventually, right? And also as you have already, watched this news recent days, right? There are 6 companies, right, are developing vaccine in the US, right? So we hope at least 1 or 2 vaccine will be eventually effective, right? After the trial, right? There are already several vaccines, right, under the trial right now, right? We hope FDA will be eventually approved, right, 1 or 2 vaccine, right, for us, right? If not, right, there will be possible second wave of what infections in the winter. So why I show this curve? Because this curve is also matters when we do what? Global portfolios diversification. Because what? Because this is a US case, right? And if you look at the other country case will be different. For example, Italy, right? Italy, has a very severe, infections before, but now they already control their what? Spreading. So their curve will be like this way, right? So the peak appear earlier than US. And also you look at the other country like China, right? The peak maybe even earlier, right? So the different countries reach the peak on a different time, right? So when we do the portfolios diversification, you should also consider about what these cycles, right? These cycles, right? So maybe some countries already on a recovery, right? Right? So their economies were growing faster, right, than us. If you want to do investment, maybe now you should also consider to investing in this country recover earlier and sooner than us, right? Then once our country reopen our economy, right, you can also put your money into the US market, right, to get a increase, right, for the recovery of our economies, right? And also some country like the Singapore's, right? The Singapore, not never have very severe infections, and also Japan, right? So their economies are more robust, right, than than China and the US, right? Especially for this special pandemic period, right? So if you happen to invest in, right, not just in the US and in Japan and in the other countries, maybe your portfolios, right, will be not less than 20%, right, as many fund showing recently, right? And also if you pay attention, right, to the recent investment news, right, the Tesla also show a big win, right, in the last week, right? Only when Elon Musk Twitter about something, right, on a Friday the price going down, right? However, today price already recovered by what? More than 5%, right? So Tesla is a very special case for investment, right? Every time, right, the Elon Musk Twitter something on a website, right, the price will fluctuate quickly, right? So you can always, buy cheap and sell high for Tesla to get a good return, right? You can follow the Twitter of the Elon Musk, right? Once he says something crazy, right, you can sell the stock, right? And you can see the stock will going down quickly. You can do some short positions, right? But once he stopped to Twitter something crazy, right? The price will be recover very soon for the Tesla. You can do some long positions, right? The stock price will going up quickly, right? So there are many things you want to pay attention, right? For the investment, right? For the portfolio investment, right? For diversifications, right? And also to capture the impact of social media should be also one important strategy, right? For nowadays investment. So let's go to the most important things, right, for this chapter, right? I show this chart, right, also from our textbook. If you have our textbook in your hand, you can open your textbook to see more detail, right, for this one. Right, this is a table, right, showing the stock market for different countries, right? So let me show the detail, right? You can see there are 12 major markets, right? And including Australia, Canada, right? France, Germany, Hong Kong, Italy, Japan, Netherlands, Sweden, Switzerland, UK, and US, right? And see what this triangle tells us about. This triangle measures what? Measures correlation coefficient between each two countries, right? For example, right? What this one means? This one means the Canada market correlation with what? Australia, right? What's the correlation? Is 0.68, right? It's a high correlation. It's positive correlation, and it's also high, right? But it's not like perfect. That means when Australia stock increase, right? The Canadian markets should be also increase, but not perfect, right? Not perfect like this one. I like this one. And you can also see the other correlation, right, in this table. So which two countries has the highest correlations? Let's say the numbers, right? Which one has the biggest value? We see the number here, right? Let's see the numbers quickly, right? Cross different column and cross different rows, right? Which one is the highest value? Is this one, 0.7879, 0.79. That's between what? Between the Germany and what? France, and also Netherlands, right? With the France. These two countries, these two pair of the country have the highest what? Correlation coefficient. And so it means these two markets are what? More integrated, right, than the other what? The other two pair of the countries, right? So that's the correlation means, right? Means the connection between each two countries market. Next one, we will interpret the other columns here. The first one is the mean. Mean means what? Means expiry return. Let's say which one generate the highest expiry return. Which one generate a highest what? Expiry return. You can see here, right? 1.067, right? 1.28, 1.728. Right? Which one is highest in this column is here, 1.28, right? Means the Hong Kong market generate the highest return in this period from 1980 to 2015. So why the Hong Kong generate highest return among this country? Because the Hong Kong market listing the stock in what? From the China, right? And China has the highest growth rate, right, in the past decade, right? That's why the Hong Kong has a highest return, right, among this country here, right? And which country has the highest risk? As we mentioned before, right, in the mean variance analysis, right? If you want to get a higher return, you must to take a what? Higher risk, right? And this one is actually confirmed, right, in this table. We can see here, right? Which one has the highest risk? Also will be what? Hong Kong, right? It's 8.21 as what? As the standard deviations, right? So Hong Kong with the highest return and also highest what? Risk. Next one, we will see the beta, right? What's the beta? Beta measures what? Beta measures the systematic risk. Right? So which country has the highest systematic risk? You can see here. 1.14, right? So it means the German has a highest what? Systematic risk. Right? And if you compare the Japan, Japan and the US, right? Which one is a higher beta? Japan, right? Means that Japan is more sensitive to the world market than the US, right? So if the world market, change, Japanese market will be more volatile than the US market. And also Germany shows the highest volatility, right, among all these countries, right? So if the whole global, right, has some event happened, right, like this pandemic, right, which country will shows what? Highest volatility? Based on these tables, right, will be what? Will be the German market. Right? That's the beta means, right? Beta measures sensitivity of the market to the world market, right? So that's the beta means. So all these interpretations is very important, right? You will see some questions in the final, right, to interpret, right, these indicators. right? For example, the correlation coefficient, right? Mean, risk, beta, right? And this one is what? It's called a Sharpe ratio, right? Sharpe ratio. William Sharpe is also a Nobel Prize winner, and he tried to what? He tried to measure relative return, right, based on the risk, right, you take. How to measure the Sharpe ratio? Sharpe ratio is measured by what? Use return minus risk-free rate divided by what? Divided by the sigma. That's the Sharpe ratio. Which one has the highest Sharpe ratio? You see here. This one, right? It's for the Switzerland. Sorry, it's not Switzerland. Actually, it's what? It's the US, right? So for the same risk, US market give what? The highest return, right? You say for the Hong Kong, right? High risk, high return. But for the same risk, which one give you the highest return? Actually, you see here, right? Is what? Is the US market, right? So if you are investors, right? Of course, if you want to invest in among this country, which one's the best? US, because with the same risk, right? US generate a highest what? Return, right? That's the Sharpe ratio means, right? So you can say our rank is based on what? It's based on the Sharpe ratios, right? You can search for Sharpe ratio on Google, right? There are many discussions about Sharpe ratio, right? Based on Sharpe ratio, which one is the best? It's US market, right? And which one is the next? Switzerland, right? Then our Netherlands, right? Then UK. Actually, the Hong Kong is only ranked on what? On the 5 because the risk is also high, right? If you invest in the Hong Kong market, right? So that's the meaning of these indicators, right? You want to pay attention to, compare with different what countries, right? For the investment. And you can see more details, right, on my, table to show the structures here, right? And you can see for relatively low international correlations, right? You can see all the correlations are less than 1, right? Imply the investors can reduce the portfolio risk if they can put their portfolios, right, into different countries, right? When we try to measure the portfolio's risk, we say our terms, right, will be WA, sigma A, right, plus WB, sigma B, and plus the 2WA, WB rho, right? Sigma A, sigma B. You can see if you can put our stock into the foreign markets with a low correlations between the countries, right? Your portfolio risk will be what? Will be reduced or be reduced. So that's the benefits if you can diversify internationally, not what? Not just the pure domestically, right? So you can enjoy the risk reduction from the global diversifications. You can see this graph to see more details, right? You can see here, right? If you put the stock only in the Swiss companies, right? You can see the risk is relatively high, above 0.44%, right? If you put in a pure US stock, right, it's 0.27. It's lower than Swiss. However, that's a third case, right? For the global stocks, right? You put 2 country stock together, the risk will be even lower than each country's risk, right? For our global stock risk, even less than each country. That's the portfolio spot. Diversification's benefits, right? If you put more country stock, right, into a portfolio, risk will be even further reduced, right? So how to solve the optimal portfolio selections, right, among different countries? We will see the detail in the next lecture, in the next lectures. For today's class, I hope you will review the questions we just solved in this class. Next class, we will do something about what? About portfolios diversifications. Just one examples we will show in the next class. Then we will do our review. Right? Before we finish today's class, let's take our review for something for we measure at the beginning of today's class forward for return, right? And we want to check what's the exchange rate will be contribute to a return, right, in proportion. I say here, our return, for the investment, if you investing in a foreign market, return comes from the two parts. One is the return from what? From the currency return, right? So the currency return in a foreign market, right, means for example, in the previous questions, right, in the US, right, what's the dollar return, right, in that stock, right, will be the RI. What's the EI? EI is the dollar appreciation. Right? So once you transfer dollar to the euros, right, what's your gain from the dollar appreciation will be this part. So our return including what? Two part, right? So we use geometrical mean, right, to measure it, right? So 1 plus return from the price change, right, of your asset times 1 plus exchange rate change, right? Then this product minus 1 will be our return, right, in a foreign currency. And this return you can see here, right, including two terms, right? And we actually ignore this part in our calculations, right? In the first questions we solve in this class, right? We ignore this part, right? But if you want to make the calculations more accurate, this part should be also complete, right, in your calculations. For most calculations, we will just ignore this part, right? We will just focus on these two parts, right? Because this one is very small, right? And this one is measured by the what? Price change. And this one is measured by what? Exchange rate, right? Appreciation, right? So ET minus 1 over what? ET, right? Let's say one questions. For example, right, if you are US resident, just sold a shares in a British firm, right, has a 15% return in a pound during a period, and also the pound depreciate 5%. What is his dollar return, right? You can see here, it's including what? Two parts, right? The first part is the value of asset increased by 15% in a pound, right? But at the same time, you are in US resident, right? Your money will convert to the dollars, but the pound unluckily depreciate, right? So we need to also take the exchange rate change, right, into the considerations, right? So our returns will solve in this way, right? So this part is from the capital gain, right, from your asset in the British pound, right? This is the pound depreciate against to a dollar, right? So minus 1 is the return, right? And for risk, also will including what? Two parts. Be careful, right? First one, the risk will including what? The capital asset value change, right? That's the risk of the return itself. And this is the risk from what? For the currency appreciation or depreciation, right? And be careful, there's a third term for what? For the covariance between these two, right? Means there are possible interaction between the return and what? Exchange rate, right? And we also ignore this part, right? This is very small, right? So we can add in this risk by use these calculations, right? So you can say I already summarized, right, risk into what? Into the three channels, right? The first channel is from its own volatilities, right? Second is the covariance, right, between the local market, right, and our asset. Last one is the cross product, right? This part we will ignore, right? So today we will finish the class here, right? I see the hours already, approach the 8:30, right? So we will finish class today, right? So next class, first we will finish the remaining slides, right? Use the questions we left here, right? Then we will start to review for the final